What's going on, guys? Welcome back, and in this video it's going to be a coffee shop face-off, and I'm going to be looking at two of the world's largest coffee chains, Starbucks and Dunkin' Donuts, and doing a full head-to-head comparison in a stock analysis manner. And I'm going to be looking at these two companies, exactly what is attractive about both of these companies, and really which company do I think has the upper hand. If you guys have been following my channel, you guys kind of already know what my answer is going to be. But I figured that I was just looking into Dunkin' Donuts again recently to kind of figure out, okay, how do I want to position my portfolio? Do I want exposure to Dunkin' Donuts? And this is kind of my takeaway on why I chose to not start a position in Dunkin' Donuts. So if you guys are interested in learning about that, make sure to hit that like button, hit the subscribe button, hit that bell notification, and let's get into the video. So just some quick background information when looking at these two companies. Both companies are pretty well-known coffee shops. They were both established in the early and late 90s. And, they kind of took two different directions with that whole coffee chain situation. Starbucks, as we all know, became the the world's leading coffee brand for that coffee shop experience, while Dunkin' Donuts kind of stayed true to its roots, and it became the economic-friendly coffee chain, and it was mainly focused on, people that didn't want to spend an arm and a leg for a cup of coffee, but through numerous locations, you can get one at any point in time. So, there's kind of two different routes that they took with this. Starbucks wanted to appeal to the enthusiast-based coffee drinkers that wanted to have a standard cup of coffee relatively anywhere that they could go, and Dunkin' Donuts that wanted to kind of fuel everybody every 10 feet having a location here in New England, and pretty much you don't have to pay an arm and a leg for a cup of coffee like you do, say, in Starbucks. So two different directions. They both have been rapidly expanding ever since their inception, with Starbucks totaling just under 30,000 stores globally, 17,000 of which that are in the United States, and Dunkin' Donuts totaling just about 20,000 stores, with 11,000 of them here in the United States. So these companies have definitely expanded, and I would be shocked that if any of you watching this here on this channel right now have not at least run into one or both of these coffee chains, because they are pretty well saturated throughout the world. But there are some major differences between these two coffee chains, and there are things that you definitely have to take in consideration if you are thinking about adding in a coffee play into your portfolio. Coffee is highly addictive, highly dependable. People generally, once they start drinking coffee, they will drink anywhere between 1 and 3 cups a day, and largely, on their way to work, so they don't have time to make it in the morning. And so they are generally buying it at one of these two locations, and you can kind of see that, okay, there is definitely the brand there, and there's definitely the brand recognition between both of these companies. But what is the main difference between the two, and what is the main difference as an investor for these two types of investments? So you look at the two companies via a store comparison. Dunkin' Donuts is roughly 70% the size of Starbucks. However, when you look at the market cap and the actual size of these two companies, it is vastly different. You can see that Dunkin' Donuts is worth roughly $5.75 billion, and Starbucks is staggering at $88 billion of a market cap. Now, when you look at this market cap comparison, Dunkin' Donuts is roughly 7% of Starbucks. And with the fact that they have roughly 70% of the amount of stores that Starbucks has, you often think to yourself, like, what is causing this astronomical difference in the size of market cap? Obviously, Dunkin' Donuts has enough locations. Obviously, Dunkin' Donuts is, pretty girthy. Many people know about Dunkin' Donuts. Many people recognize that brand, and they will go there to get a coffee. Now, why exactly is there this big of a size difference between these two chains? In my opinion, it is largely due to the fact that Starbucks is a much better run company, and Dunkin' Donuts really has been playing catch up over the past couple of decades to really understand how to, operate a store like Starbucks does. And it also comes into a couple of other situations that Starbucks is definitely executing where Dunkin' Donuts is not executing. And so let's kind of go into the financial ratios and looking at the individual companies and what they're trading for, relation to how well their overall companies are performing. So looking at the quick key ratios that, you kind of look at initially whenever you look at any investment, you have Starbucks with a PE of 31, price to free cash flow of roughly 9, debt to equity of 8.1, which is extremely high, when you look at any other industry except for the restaurant industry that generally have extremely high debt to equity ratios, largely due to the fact that they are taking on debt every time they want to expand locations. So realistically, that is pretty high, but not astronomical for this individual industry. The dividend yield is roughly 2% for Starbucks. And then you take all of that and you compare it to Dunkin' Donuts, one of their direct competitors, and Dunkin' Donuts is trading at a PE of roughly 25, price to free cash flow of almost 50, negative debt to equity ratio because they have negative equity currently, and their dividend yield is roughly 2.15%. In a apples to apples comparison of these ratios, Starbucks is roughly either in line with what Dunkin' Donuts is trading for or blowing them out of the water when it comes to their price to free cash flow. And a lot of you might be asking exactly how the heck is Starbucks trading at a price to free cash flow of roughly 9 when Dunkin' Donuts is close to a 50, and that is essentially just to show how well run a company directly affects these ratios. So if we look at their actual financial performance, you have Starbucks with an astronomical ROE of 222%, an ROA of 15%, an ROC of 37%, and an interest coverage ratio of 18.04. And then you take that and you look at Dunkin' Donuts with a negative 52% ROE, an ROA of roughly 12%, and an ROC of roughly 11%, and an interest coverage of only 3.6%. It's extremely intriguing to see how drastically different financial performance these two companies can be even when they're operating in roughly the same industry. Now, again, there is, difference in management, different in strategies. So obviously Starbucks has been focused on, not really licensing stores until very recently, while Dunkin' Donuts went the pure franchisee route. So this has allowed Starbucks to really kind of milk all of their locations for all of their money, and really all that profit is going directly back into the business. Unlike when you have Dunkin' Donuts, that Dunkin' Donuts is generally paying for a lot of issues with their franchisees, and the franchisees are taking a lot of that money, and it's just not nearly as profitable for any type of company, as we can see by these numbers, to really license out their stores as it is to just own them wholeheartedly. Now, obviously, Starbucks has been starting to do more and more licenses in markets that they're not that familiar with, i.e. China. But Dunkin' Donuts has been licensing all of its stores even in the United States. And you can see by these numbers that it has not been executing well. And we can see that while if you look on their balance sheets, Starbucks has an astronomical amount of debt in comparison to Dunkin' Donuts, but with the amount of money that they're bringing in net income each year, or even if just looking at their EBITDA, which is what this number is relating to, Dunkin' Donuts is only covering about 3.6% of its yearly interest payment. Starbucks is taking in enough money that it is able to pay its interest payments 18 times over. So even if we hit an economic recession and say Starbucks loses 50% of its revenue and this interest coverage goes down to 9, the company is still better off financially, at least keeping afloat, than its competitor Dunkin' Donuts, which is absolutely amazing in my opinion. Now, obviously, Dunkin' Donuts being the economic-friendly coffee shop shouldn't experience nearly as much of a downturn in revenue during a recession as Starbucks would, but with only being able to cover its interest payments now during the end of a bull market, and with everybody seeming to have extra money to really throw out at a coffee shop, only being able to cover its interest by roughly 4 times, I'm kind of fearful about Dunkin' Donuts' financial well-being if we ever hit an economic downturn, largely due to the fact that they just simply are going to have so much debt that they don't have enough money to pay for. So to me, that's one of the biggest things to think about when looking at these two companies and putting them in your portfolio, is which company is more likely to survive the next recession. And from these numbers right now, and from the amount of cash they're both generating, assuming you think that Starbucks will take a bigger hit and that Dunkin' Donuts will take a smaller hit, no matter which way you slice it, Starbucks is going to be in a better financial standing for, living past the recession. And that's just one of the biggest things that I think about when looking for these types of investments. Now, quickly looking at the stock price over the past 5 years, you look at Starbucks that's going up almost 100% in 5 years, when you look at Dunkin' Donuts that has barely made 40% in 5 years. So obviously, investors have kind of noticed this drastically different performance in both the business and in the stock price, because obviously people are looking to Starbucks as a much better option than Dunkin' Donuts in comparison when looking at that coffee chain type of investment. So I personally do not see any real reason why an investor would choose Dunkin' Donuts over Starbucks pretty much in any regard. Now, obviously, I am from Massachusetts. If you go outside, you can pretty much find a Dunkin' Donuts every 20 feet, and that is not really that much of an exaggeration. Anybody that lives here knows that we have more Dunkin' Donuts than just about anything else. It's extremely mind-boggling to someone like me that has grown up seeing Dunkin' Donuts everywhere and everybody rushing out to go and get their coffee in the morning, that Dunkin' Donuts is so poorly run in comparison to Starbucks, their number one competitor. Now, Starbucks has actually started to really increase the amount of stores here in Massachusetts, and I'm actually seeing, pretty much the heart and the home of Dunkin' Donuts. All of the people in my age demographic are starting to switch. Rather than getting a Dunkin' Donuts cup of coffee, they're switching to a Starbucks cup of coffee. And to me, that is a big red flag for anybody that's invested in Dunkin' Donuts, because essentially Massachusetts is, kind of the state that, pretty much goes by the motto, America runs on Dunkin'. and more people are converting to Starbucks drinkers than Dunkin' Donuts drinkers, at least in the young age group. So to me, that is a really big issue that Dunkin' Donuts is going to have to face, especially if it wants to continue to grow over the next, say, 10, 20 years. So definitely by any way that I could look at these two companies, just as a one-on-one comparison, Starbucks is hands down the better investment. And even currently, if you were to say pick either one of these companies, if you're doing a comparison analysis, neither one of these companies is, say, drastically overpriced in a PE sense. But when you look at all the other ratios, Starbucks is just hands down a better performing asset. And I can definitely do a more in-depth breakdown of what their ROE is, how much of that is coming from debt, how much of that is coming from actual business operations for either one of these companies. But hands down, I do not see any reason why someone would choose Dunkin' Donuts over Starbucks for an investment. And now just to take a quick look at what the companies are doing, currently and what they're currently executing on. Starbucks is aggressively expanding in China, as we all know. And China has kind of the make it or break it situation for Starbucks over the next 10 years. Because if Starbucks is able to properly execute in China, Starbucks has the ability to more than double the company in terms of revenue and in terms of net income that it's bringing in. China is roughly 3 times the size of the United States, so if Starbucks can become remotely as profitable in China as it is here in the United States, you can see Starbucks becoming a $150, $200 billion company based off of how well it is executing in China, whereas you have Dunkin' Donuts that is struggling here in the United States to even become as profitable as Starbucks, and it's also trying to expand into other international locations, but the amount of issues that it's been having with its franchisees kind of, dealing with that balance between customers and store owners and, just trying to make everybody happy, it is definitely not working out that well. So I definitely think that Starbucks is going to have a much easier time expanding on its goals than Dunkin' Donuts is essentially having to play catch up before it can even think about expanding into new markets. So that is my relatively biased opinion, based off these numbers and based off of my investment philosophy. I definitely think that Starbucks is hands down a better investment than Dunkin' Donuts, but I am interested to see, what your guys' thoughts are on these two companies. Are you invested in Dunkin' Donuts, or are you invested in Starbucks, or are you invested in neither and you're just thinking about investing in coffee? What really is the main factor of why you would go Dunkin' Donuts over Starbucks or vice versa? I'd love to know it. Hope you guys got some use out of this video. Let me know if you guys have any other questions about stocks they want me to do a direct head-to-head comparison down in the comment section down below. And thank you again for watching, and I'll catch you guys in the next video. Peace.